I think because the real participants are professionals. I mean, yes, there's a lot of silver stackers and there's an industry that needs it. And the industry doesn't really, I mean, they care about the price, but these days they care more about ounces. How many ounces do I need over the next 2 years to keep Samsung viable? How much does Tesla need over the next 2 years to run all the, manufacturing that Tesla does with silver? So I think they're more concerned about what is the flow rate, what is the amount of silver that's actually readily available physically, rather than, how far is the market moving or what are the rules. Having said that, I think it will tone down the market, maybe calm it down. I still expect higher prices. I don't think the top is in. I think we're in the final phase. I've talked about 90% of the move coming the last 10% of the time. We are there. How much longer do we have to go? I don't think very long. I think we could see the ultimate peak in gold and silver in the next year or two. There's many that disagree with me, and that's fine. And I'm not saying I'm right. I'm saying how markets move, what I've studied, and what I think. So I just did my mastermind with Mike Lorenzo yesterday, and he said that on the rule of thumb, the general market is silver's 40% of the solar panels now. Well, that's significant. So they're looking for alternatives, copper, graphene, or maybe, making mitigations. There really aren't any substitutions now. But the point is, I think it will. The markets really are efficient over time. They're inefficient at times. That's why we invest. This is undervalued. I'm going to buy it. Oh, it's overvalued. I'm going to sell it. But right now, the efficiency in the silver market remains to be determined. But as we get more and more toward a cash-only market, which I don't think we'll ever go to, I'm not sure it's the best. I think we do need to be able to hedge. When we get, let's say, the rules in place that it's more realistic as far as how much can be hedged versus how much is produced, we're getting into that kind of balance. I think you're going to see a much more stable market, and I think you're going to see less, violence. But I think we're going to be quite violent. So last comment on your question. I'm looking for the gold-silver ratio. That's really the only way not the only, but one of the best ways to determine silver being overvalued or undervalued. If we get to a 30-to-1 gold-silver ratio, which is roughly double where we are now, meaning silver's outperforming gold 2-to-1 from this point forward, I'd start looking at taking some profits off the table. Could it get beyond that? Yes. Could it get to the classic or monetary ratio of 15, 16-to-1? It could. Could it go below that? Yes. But I don't think it's going to go much below 30-to-1. But time will tell. But that's when I know that the physical market or the silver market is at a level that we should really consider enough's enough, taking at least partial profits. Its investment in silver is kind of a staple in India, and it was that way, and it still is. But as India got more and more wealthy, they moved to gold. I mean, it seems that the population prefers gold over silver, but they still like silver. Now that it's become more and more wealthy, you're seeing ETFs deployed in India, as you just said, which means the more and more ability to invest in silver without having to buy a silver bracelet, down the road type of thing, and really be able to participate in, let's say, substantive amounts outside the physical realm. Of course, the ETFs are backed by physical. Point being, I think that we have a double whammy, meaning the industry's got a place where they are not satisfied with the amount of silver they hold in reserve, and investors have more ability to buy silver in size worldwide than ever before. So first of all, 2025 surprised me. I mean, I did call, like I said, hey, it's time to get into silver if you're not. But the 140%, that surprised me. January definitely surprised me. I wasn't all that happy, even though, my personal portfolio is looking pretty good day by day. But I go, this can't last forever. And if this thing goes all the way up to 200, for example, that could be. Didn't. It stalled out at 124 or something like that. So I think we need to, take a deep breath and let the markets work the way they're supposed to. When I'm looking at, these rule changes in the Chinese market, I made friends with Eric Young, who seems to have a very good handle on what's going on in China, who lives in Hong Kong, and I've interviewed him personally once or twice. I listened to most of his interviews. I also think that there will be some changes in the COMEX. That's a gut feeling. I don't have any inside information, but I have a feeling that these position limits that do exist may start to be enforced, especially with China taking the lead. I think there may be something. And the exchange itself is going to say, wait a minute, boys, we've been kind of turning our heads on this, this part of the contract or the limits, and maybe we should relook at that. So we'll have to see. I would like to see a more orderly market, but that's not what the metals portend. Metals portend at the end of the great inflations, violent moves to catch up with the misallocation of capital and the happy spending that the governments have done worldwide, and they pay catch-up mode. And that usually happens in a big hurry. And that's what we're witnessing now. What we have seen for decades in silver is that the COMEX sets the price, and that does set the physical price. And as long as there's enough physical to meet demand at that price, then everything's good. And once in a while, we would see it slip away. And usually for a matter of 3 days, you'd see a big backwardation. It lasts for a couple of days, and then all of a sudden there'd be enough silver to fill that gap. Everyone's satisfied. The people that had to have silver that day got it, and things go back to normal. This time it's different. What's different? Well, what's different this time is that China is using this big demand for physical metal is in the arena of the COMEX, meaning it's commercial 1,000 ounce bars. So even though the retail market can have an effect, it's a flea on a dog relative to the tail of the dog. So once the industrial needs were not met, you saw that the physical market took over the silver price. And that has happened, as I said, very sporadically in the past. This time, it was the real deal. And we saw something that we haven't seen in a long time. We saw the silver price in 2025 go up 140%. We haven't seen those kind of years in a long time. Yeah. Secondly, we saw what happened in January as the price went up 70% in 1 month. Now, I am not here to be an apologist for the bankers. Anyone that's listened to me for more than 5 minutes knows my thoughts about that. However, it is a derivatives market, even in China. The market did get ahead of itself, and it was overextended, and the paper price or the paper paradigm took over. So temporarily, even though the physical 1,000 ounce bar market had basically taken control for weeks, perhaps months, and everybody's kind of cheering that understood what was really happening, it didn't negate what was going on in the futures exchanges around the world. And again, they got ahead of themselves. There's lots of talk about what happened, about a huge Chinese short. I think part of that's true. I've been able to verify it, but a good friend that's a hedge funds manager verified it to me. So that brought things back into reality. So that is now where we are. So now we're in a struggle between who's going to win from this point. And it could go back and forth a couple more times. Is it the paper pushes or is it the physical demand? Everyone talks about deliveries and the drain of the COMEX. Well, the COMEX actually today, I haven't looked in the last week, but as of a week ago, the start of 2025 had X amount of silver in the vaults in COMEX. January 2026, a year later, there were 100 million ounces more in the COMEX than there was the previous year. Now, a lot of that was steady Eddie. It just stayed level, and then it increased with all the metal coming from the LBMA over to the COMEX. Then we got in that switcheroo, as you recall, and metal left the COMEX back over to London. So right now, what happens on these deliveries most of the time is it's what I call a retagging. HSBC sells to JPM. The metal stays on the floor, in the vault, on the pallets, and the tag that owns it changes. One comes off and another one comes on. It does not move. That isn't to say that the COMEX doesn't have metal that leaves the exchange. It does. But to answer your question, well, where is that stress? You really have to look at what the inventory is in the registered category, primarily on the COMEX, which right now is much, much above where it's been in the past for a low, around 30 million ounces. That was like the lowest I've seen in a long time. It stayed there. It's well above that now. And then on the Chinese market, it's hard to get data, although I am on their website to see exactly where that stress is. Actually, I hate to use the cop-out. I have to see more data, but I kind of need to know. We do know it's at a low. We do know that there's a huge drain, and I would just make an educated guess, Jeremy, that it's stressed right now, and if it goes any lower, there'll be more stress. That's the best I can tell you. People are going to hate me, and, again, I'm not a lover of the bullion banks and banking system at large. Let's keep that on the record. But banks do not like risk. So a lot of this idea that the banks are massively naked short just is not true. The bullion banks basically control the market. How do they control it? Through physical metal that they leverage in the futures exchange. And is every one of it covered and not naked? No, they are naked short. However, not to the level that people believe or are taught or told over and over again. Most of that metal has some backing to it. Again, it's not a one-to-one. Having said that, it's the commodities trading funds. It's what we call the opposite of the commercial, the banks, and it's the public that are basically doing the nakeds. Not all of them, of course. stores. So the balance between the longs and the shorts have to meet. There's a winner for a loser. There's a zero-sum game. The banks almost always win, but they're not as leveraged nakedly as it is touted to be. And this is something that I guess people just don't understand or want to believe that. They want to make the banks the bad guys. I kind of do, but I also want to be as objectively true as